All right, let's move on to what all this means for the outlook for 2021, for the economy and the markets. Ben Mandel is joining us now. He's global strategist at JP Morgan Asset Management. Ben, it's good to see you. So we're talking about stimulus here heading into next year. We know also that households built up some savings in 2020, which has been unusual compared with recent years. What happens then in 2021? Are we going to see people just paying their rent checks, paying their bills, or will there be some unlocking of spending?
First of all, thank you very much for having me as we close out this extraordinary year. I think we're going to have a few more extraordinary years in many respects in the coming years. There are some echoes here of the Roaring Twenties in a very strange way. So far as you're going to have a very persistent effect of the pandemic on consumer behavior as we move forward. And a lot of that, as you're saying, is as a result of consumer savings. Consumers, and fiscal policy is a big part of this, have accumulated a lot of savings over the course of 2020, tend to mount by somewhere around 8% of GDP. When all is said and done with the current round of stimulus, it'll be about 10% of GDP, and saving rates are still high. And so as we move forward, we're going to see a few things happen. One, obviously, is that as people get put back to work, household income goes up in aggregate. That's a good thing for consumer spending. But the major tailwind and the very persistent tailwind is going to be the spend out of that cash pile that's been accumulated over the course of 2020. And that can lead to a very persistent tailwind for GDP. Keep in mind, consumer spending is 2/3 of GDP. And you could have a scenario where we're running well above trend for the foreseeable future. Just to be concrete here, in the long run, we see potential growth for the U.S. economy at about 1.8%. It wouldn't be unusual to see a period of 2.5%, 3% that's sustained over the next 1 or 2 years. And so it's a very powerful force in the outlook going forward.
Ben, you're painting a picture of perhaps maybe stronger than expected growth next year. How should investors think about valuations? Should they pay attention to stock valuations today, which by really all sorts of measures look frothy to the average investor?
Valuations for equities are certainly high with respect to themselves. However, in a balanced multi-asset portfolio, they're not as expensive as bonds are. And so when you put together the overall story, which is an early cycle rebound, which is going to continue as that above trend growth plays out, ample policy support, and we see that monetary policy is continuing to be accommodative and hedging downside risks as that plays out. Putting all that together, it's still the case that we'd expect stocks to outperform bonds over the next 12 to 18 months. And so that's one aspect of a pro-risk tilt that we have in our portfolios. The other major tailwind for risk assets is going to be as the trend for vol continues to decline. That's something which can push risk assets further, even though valuations aren't that compelling. So for an asset class like credit, credit spreads are tight by historical standards, but as vol declines, you can imagine them going even further in that direction. And so valuations we consider as an important aspect of the long run performance of our asset classes, but in a balanced multi-asset portfolio, they can still push a little bit further in favor of risk assets this year.
Ben, if we look at what's happened in the economy over the last 6 months, how the market has reacted, it's very early cycle in a number of ways, but we also see animal spirits, Bitcoin, SPACs, kind of the speculation, EVs, so on and so forth. How do you square those two dynamics? Because certainly the beginning of cycles, typically everyone's bummed out. Everyone's not excited, but it's a lot different this time around.
Yeah, this is a very different cycle. That's exactly right. In fact, ever since the beginning of the pandemic, we've been characterizing this as, in part, a classical recession dynamic and hence recovery dynamic, but in part, natural disaster, which has a sudden stop dynamic to the economy, but then also a sudden start. And so a lot of the V-shapes we've been seeing in economic activity, in markets as well, animal spirits, to your point, all that is a result of the fact that this is not a normal business cycle. You have part of it, which is getting back to, coming back to life very quickly. We'd expect actually that dynamic to continue as persistently impaired parts of the economy, particularly in services, come back to life over the course of 2021. And so this is an early cycle economy, but where you'd expect actually some characteristics of mid to late cycle, including those animal spirits. That can be a positive for the outlook. I'd also highlight it could be a negative as well, in the sense that corporate leverage, which was the bugbear of the end of the last cycle, and we'd been looking at that, corporate balance sheets and high levels of leverage as a risk to potentially end the last business cycle. Corporations have come through this not only with the same amount of leverage, but even higher than they had going in. And so there's some aspects of this business cycle which are going to be very unusual, including the fact that corporate leverage is going to come back as a concern for the end of this cycle as well. And so we're moving very briskly through this business cycle. It's an unusual one, and I think we're going to be looking at corporate balance sheets as a potential threat going forward.
It's interesting, Ben, that you bring that up, because we had a discussion about this yesterday with a credit strategist who seemed pretty confident that companies are going to pay down their debt going into next year, that's going to be something that's going to characterize 2021. It sounds like you're not necessarily as confident that is going to be happening.
Yeah, I think strategists look at the numerator of debt to EBITDA. Maybe economists look at the denominator. I think what we're, if leverage statistics go down, it's going to be because earnings are going to be great next year. But it's building up to be a very positive year for earnings. The baton is going to get passed from valuations to earnings in terms of overall equity performance. And in credit, you'd expect that to be relatively constructive as well, insofar as you're going to, some of those debt to EBITDA statistics will edge down as earnings recover. So it's not really a story of the next 12 months. It's really about looking out over the horizon. Once we've cleared the pandemic and all its implications, what is going to be the end of this business cycle once we're through that? I think we're going to think, this idea that corporate leverage is the reduction of a shock absorber for firms to keep spending and hiring when they get a negative shock to earnings in the future is going to feature prominently in discussions about how this cycle will end.
Gotcha. All right. Ben Mandel, Global Strategist at JP Morgan Asset Management. Thanks, Ben. Good to see you. Happy New Year.
Likewise.